Before we begin, welcome back to Boring Currency. This channel tracks what's happening beneath the surface: physical metals, paper market stress, and the forces reshaping the global financial system. Tap like, subscribe, and leave a comment so I know you're tuned in. A document has reportedly emerged that was never intended for public eyes. A document that, if genuine, would validate what many have believed for years, but could never conclusively demonstrate. A document that claims to reveal deliberate interference in precious metals markets by one of the most powerful banking institutions on the planet. According to those circulating it, this is an internal J.P. Morgan Chase memo dated 3 days ago, and it allegedly includes explicit silver price targets for the coming week. Not forecasts, not rough estimates. Targets, meaning predefined levels the bank is supposedly aiming to drive price toward through coordinated market action. The story goes further. The memo was allegedly attached in error to a routine regulatory filing that appeared on the U.S. Securities and Exchange Commission database for exactly 17 minutes before being pulled. 17 minutes was reportedly enough for quick-moving researchers to capture screenshots, download the file, and begin analyzing what they describe as potential smoking gun evidence. But this isn't framed as simple manipulation. The claim is much larger: that the document represents mathematical proof silver prices are not set by supply and demand, but by banking algorithms designed to extract maximum profit from retail participants while protecting institutional exposure. The leaked memo allegedly lists 3 precise silver price targets for the next 7 trading days. And it's the accuracy that's making people uneasy, because it implies a level of control that shouldn't exist in a truly free market. Yet in the document's alleged language, silver is treated like a managed inventory entry, not a market discovering price through buyers and sellers. Target 1 is labeled the retail capitulation level, set at $71 per ounce. The memo reportedly describes this as a planned drop meant to trigger stop losses and force leveraged traders out. It allegedly even details how selling pressure would be concentrated during low-volume sessions when liquidity is thin and prices can be pushed more easily. Target 2 is described as the accumulation zone at $68 per ounce. This is presented as the level where the institution intends to rebuild long exposure after the shakeout. The memo allegedly contains desk-level instructions to absorb available physical metal at that zone while keeping price action appearing normal. Target 3 is what many are calling the most revealing: the profit realization level at $89 per ounce. This is described as the point where the institution would unload what it accumulated in the low 70s. And the memo allegedly claims executing this sequence could generate roughly $2.3 billion in trading profits over a short window. That's the core reason this leak, if real, is so explosive. These aren't framed as loose outlooks. They're written like engineered levels paired with tactics, timing, coordination, and profit calculations. It reads less like market commentary and more like an operational blueprint. But the most disturbing element, according to analysts, isn't just the targets. It's the cold, clinical discussion of retail psychology and how to exploit it. The document reportedly breaks down stop-loss clustering, margin call timing, and emotional trading behavior, effectively mapping how retail traders react to specific price shocks. One section, titled something like Behavioral Exploitation Strategies, allegedly outlines how sharp pre-market drops can spark panic selling from individuals without institutional-grade risk tools. It even claims the bank calculated that a 3% drop executed between 4 and 5 a.m. Eastern could produce 15 times more retail selling than the same decline during regular hours. Another section reportedly discusses sentiment reversal mechanisms, describing how bearish news can be timed to hit key technical levels and amplify selling pressure. And the memo allegedly references coordination with financial media, so negative silver narratives align with engineered declines. If that's accurate, this isn't just price movement. It's theater designed to transfer wealth from individuals to institutional trading desks. The memo also allegedly argues silver isn't being managed purely for silver profits. It's framed as a hedge control mechanism for much larger portfolios, massive derivatives books that could destabilize if precious metals volatility breaks free. In that framing, suppressing silver isn't merely a trade. It's a stabilizer for broader financial markets. By keeping silver trapped within predefined ranges, the document suggests the institution reduces the risk of a runaway metals rally that could signal stress in fiat confidence and debt-heavy systems. The leaked document reportedly references currency stability operations and systemic risk management, implying silver control is part of a broader confidence maintenance strategy. High silver prices are described as a threat to central bank credibility, making metals control, in the memo's tone, a matter of institutional survival. But the memo allegedly reveals something else. Maintaining control is becoming harder as physical demand presses against available supply. Multiple sections reportedly cite rising resistance, supply constraints, and growing difficulty executing traditional tactics. One of the most striking passages, the so-called physical market problem section, allegedly admits industrial demand is rising faster than mining supply can respond, and it suggests paper-based suppression will eventually collide with physical reality. But the strategy, as described, is to extract maximum profit before that collision occurs. The memo allegedly projects current tactics remain effective for roughly 8 to 12 months before physical limits force a strategic pivot. That timeline matters because it implies planning, a transition from short-term control to long-term accumulation. If scarcity becomes undeniable, this logic says the institution wants to own the metal before the rest of the world realizes what's happening. That context is used to explain why next week's targets are so precise. The idea is one last major cycle, one final shakeout to lock positioning before the regime shifts from paper control to physical scarcity. They're allegedly using the final window of effective suppression to secure the best seat in the House for the coming supply crisis. The document reportedly includes analysis of global production, industrial usage, and investment demand, painting a picture of an inevitable shortage. It claims analysts expect silver demand to exceed supply by 30% within 18 months. But instead of letting price reflect that tightening, the alleged plan is to keep prices artificially pressured while quietly building long exposure. And when suppression becomes impossible, the institution would already control the physical metal needed to benefit most from scarcity. Scarcity made even more profitable by earlier price caps. If authentic, that means the memo isn't just describing a trade. It's outlining a multi-year strategy to dominate the transition point when silver shifts from paper managed to physically constrained. That would fundamentally change how you interpret every dip, not as weakness, but as positioning. The memo is framed as confirmation that retail has been repeatedly shaken out while physical metal is accumulated for a crisis institutions see coming. In that context, next week's cycle is presented as the final setup move, because once large institutions broadly recognize the supply deficit, accumulating at current prices becomes far more competitive and far more expensive. The memo allegedly projects institutional awareness of a silver shortage within 6 to 9 months based on industrial demand and mining data. That implies a narrow window. Finish accumulation while the crowd remains distracted. The document also allegedly describes coordination beyond a single firm. It references allied position management and coordinated intervention protocols, suggesting multiple banks may be operating in parallel towards shared objectives. That's offered as the reason resistance has failed. Retail and smaller players aren't facing one entity. They're facing a synchronized system sharing information, aligning strategies, and supporting interventions. The memo reportedly cites coordination with London bullion banks, Swiss metals dealers, and major commodity trading firms. In that framing, the network controls not only paper markets but physical supply chains, storage, and delivery infrastructure, the plumbing of the system itself. Yet even within that, vulnerabilities are allegedly admitted. The document claims that if even a small percentage of silver futures demanded physical delivery, the paper structure could buckle. The memo reportedly calls this systemic fragility, a limit on how aggressive intervention can be without triggering broader failure. That fragility is why next week's cycle must be executed with precision. Shake out leverage without triggering panic delivery demand. Flush retail, keep institutions calm. The memo allegedly includes delivery capacity analysis and admits vault holdings may be far smaller than paper obligations suggest. That mismatch creates risk if delivery demand spikes. The memo reportedly estimates current vault inventory could support normal delivery rates for only 4 to 6 months. Beyond that, it warns of what it calls operational challenges in meeting obligations. That urgency explains the timeline. Complete the transition from short-term manipulation to long-term physical accumulation before vault limitations become visible. So the leak, as presented, isn't just evidence. It's a roadmap for a historic wealth transfer. Phase 1. Profit from engineered drawdowns and shakeouts. Phase 2. Profit from scarcity. Once physical reality overwhelms paper control, retail absorbs losses during the transition, while institutions benefit on both sides. The memo's precision is used as proof that price discovery and normal returns have been subordinated to institutional optimization. But even in the memo's framing, manipulation isn't permanent. Physical reality eventually wins. And when that happens, institutions positioned correctly during suppression could reap enormous gains from scarcity. The document treats that transition as inevitable. That certainty is why next week's targets are portrayed as pivotal, one of the last major cycles before permanent physical pricing takes over. Here's the key takeaway the script pushes. Retail investors who understand the timeline can choose to align with the institutional playbook instead of becoming collateral damage. The memo is presented as a preview of the next 12 months. Short-term suppression, mid-term accumulation, long-term scarcity pricing. Understanding those phases is framed as the difference between surprise and preparation. Manipulation is temporary. Physical shortage in this framing is permanent, and the upside for correct positioning could be massive. If genuine, the accidental leak would offer unprecedented insight into institutional strategy. For the first time, you'd allegedly see timelines and transition planning laid out in plain language. So the question becomes, will retail use this knowledge intelligently or keep assuming the market is always fair? Because the memo isn't described as speculation, it's described as a playbook. And the next move belongs to individuals who decide whether to fight the structure blindly or understand it well enough to profit within it. Next week's targets, as framed here, aren't predictions. They're engineered outcomes. Recognizing that distinction is presented as the line between exploitation and advantage. But there's another layer that makes this leak even more volatile. Buried in the technical language are alleged references to coordination mechanisms extending beyond one firm. This isn't one bank, it's systematic collaboration. Multiple institutions operating like a unified control system. The memo allegedly references Protocol 7 and coordinated response frameworks, hinting at inter-institution cooperation that, under normal standards, would resemble conspiracy. But precious metals markets, the script claims, operate under different oversight realities. These protocols explain why resistance fails. Retail isn't competing against independent banks. They're up against a synchronized network sharing real-time data and coordinating intervention windows. The memo allegedly outlines communication channels, timing protocols, automated triggers, and synchronized execution, creating the appearance of natural movement while applying orchestrated pressure. This is why the script argues traditional analysis often feels useless in precious metals. Technicals, fundamentals, insider chatter, none of it matters if prices are managed instead of discovered. Yet even within this framework, strain is reportedly visible. The memo allegedly notes rising operational stress in maintaining coordination while keeping markets looking normal. One section reportedly discusses recent coordination failures. Perfect alignment is becoming harder as stress rises and physical constraints tighten. It suggests coordination effectiveness has declined over the past 18 months because institutions are no longer fully aligned. Some want suppression extended to finish accumulating, others want to pivot early towards scarcity positioning before coordination collapses entirely. That internal tension creates opportunity. When large players aren't perfectly synchronized, gaps appear. And gaps can be exploited by those who understand what's happening beneath the surface. The memo also allegedly details the technological backbone of intervention, suggesting most activity is algorithmic rather than discretionary. Systems execute predetermined strategies based on real-time signals and coordination cues. That explains why price behavior can look inhuman and detached from normal market logic. But the memo admits algorithms can't override physics forever. When physical delivery demand exceeds inventory, real price discovery returns. The document reportedly outlines physical shortage protocols that would suspend suppression if delivery demand crosses certain thresholds. That's effectively an admission. Manipulation has limits when confronted with hard supply. The leak also includes a darker claim: regulatory capture. It suggests regulators aren't merely unaware but in some cases supportive, viewing intervention as a stability tool. The memo reportedly describes coordination with regulators to keep actions within technical legality, aligning responses around systemic risk priorities. In this framing, enforcement doesn't occur because oversight isn't independent. It's part of preserving confidence in fiat systems by preventing metals from acting as a monetary alarm. But even here, support is described as conditional. If shortages begin harming industry, defense production, or national security, regulatory tolerance could flip. The memo reportedly lists triggers that would end suppression support: critical supply disruptions, industrial shutdown risks, international pressure. That conditional backing is another vulnerability. Institutions can't rely on protection if their actions threaten the real economy. The memo allegedly projects regulatory tolerance could end within 12 to 18 months as physical constraints force conflict between paper stability and real-world production. It also introduces an international dimension: currency warfare. Silver suppression supports dollar confidence and slows accumulation by countries seeking to reduce dollar dependence. The memo reportedly references China and Russia accumulating physical metals and suggests suppression dampens broader participation by keeping prices unattractive and sentiment negative. That geopolitical layer explains why suppression persists despite distortions. But it also forecasts growing international resistance, alternative trading systems, and bypass routes that could force genuine pricing within 18 months, possibly sooner than domestic breakdown alone. Zooming out, the script's message is simple. If authentic, this leak is a blueprint for understanding markets where institutional control overrides natural discovery. The 7-day targets are framed as engineered outcomes serving positioning during the final phase of effective suppression. Recognizing that allows retail to navigate the structure instead of being crushed by it. And the implications go beyond silver. If metals can be managed at this scale, similar systems likely exist wherever institutional priorities clash with organic pricing. In that view, modern markets function less like free auctions and more like managed utilities. Understanding that reality becomes essential if you want to survive markets that prioritize stability over fairness. So the question is straightforward. Now that the playbook is allegedly visible, will individuals use it to level the field, or keep pretending the rules are different? Next week's targets are both threat and opportunity. If you believe they're engineered, you can position accordingly instead of being shocked when outcomes arrive on schedule. The playbook is on the table. Success comes from the discipline to trade the market that exists, not the one you wish existed. And now I want to hear from you. Do you think a document like this could realistically exist? Or is this more likely misinformation crafted to drive fear and clicks? Drop your thoughts in the comments. And if you want more sharp updates like this on Boring Currency, subscribe and comment Boring Currency, so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself.